I mean, you did see Warren Buffett buying Apple. I think it's his largest position. You're going to see him probably do the same with Facebook. There was an interesting mass extinction event tweet that went on that's related to all of this. Tom Laverio, a GP, general partner at IVP, which is a venture firm, tweeted the following thread. There is a mass extinction event coming for early and mid-stage companies, late 23 and 24. It'll make the 2008 financial crisis look quaint for startups below. I explain when, how, and why. And we'll start and offer some detailed advice. Basically, 4 in 5 early stage startups, he claims, have less than 12 months of runway, according to a Q4 survey of 450 founders by January Ventures. He sees late 23, 24 when this will all come home to roost. Mark Suster from Upfront Ventures, friend of the pod, replied with the following: precisely our internal analysis, 5,000 seed, 2.5 million raised or above, A and B companies, those are 3 different categories, funded in the last 4 years. We estimate 50% will go out of business. Loss ratios in the last 7 years have been artificially low due to excess capital, as we just discussed previously with the never-ending bridge.
We've talked about this before. If you look back over 40 years of venture capital, the average top quartile fund distributes 1.6 or 1.7x the capital they raise. Even though now we've gone through a period where people have shown these unbelievable markups, right? TVPIs, the total value of paid-in capital, distributions have not really budged that much. Distributions are still modest. They're below 2x. And so we have to go through what's called mean reversion, right? We have to go back to the historic statistical average, which means that a 50 to 60% mortality rate seems pretty reasonable. By the way, in the dot-com bubble, that's what we went through. You know, in 2001 to 2005, we had a 50% mortality rate.
At the seed stage, I mean, you kind of expect 70% to go out. Series A, maybe a little bit less. Friedberg, what are you seeing on the streets? You're investing in startups.
Yeah, look, I think that there's...
Is there an opportunity, by the way, also in here? So what are you seeing? But is there an opportunity in this group of, this cohort of companies which seem to be upside down and or in a tsunami right now?
This cohort of companies, I think, generally is overburdened with feature orientation and short-termism more than you would see in an era of reduced capital rather than excess capital. And what I mean by that is a lot of companies built a business or built a product that allowed them to show traction in the market faster. And typically those products that are easier kind of paths to market end up being features. They don't end up being platforms. So it's very hard to become a big business or to become a scaling business or to differentiate in a competitive market. That's a very general statement. But I think, you know, when you miss out on the platform play, you start betting as an investor on a lot of the derivative plays that look like the real big company, look like the platform. I mean, think about how many companies try to look like some iteration of Stripe or try to look like some iteration of Uber or tried to look like some iteration of, you know, name your big kind of behemoth. And as a result, you get all these sort of feature-ish platform plays that have maybe a niche or some kind of, you know, narrow kind of market opportunity. They got funded. Those businesses obviously aren't going to have the same valuation multiples of the winners in the market. And now, and they burnt a lot of money to demonstrate growth because so much of investing over the last 15 years has been momentum investing. And so they try to grow, then they try to get a higher valuation, investors plow more money in. Now the problem is that so many of these Series B, C, D, and E companies have a true market value. They're not a valueless company, but the true market value of them is probably less than the total preference stack of the capital that's gone in. So they're worth less.
Let me just make sure people understand that.
I'll just describe it. Yeah. So when investors invest, they have preferred stock. So they have a right to get their money back. So they, let's say a 1x liquidation preference, they invest $100 million. The company is worth 300. So they own 25% of the company after they invest, but they have a right to that $100 million first before common shareholders get paid. The problem now is that a lot of those companies may be worth less than the 100. They're not worth 400 anymore, they're worth 100. And you can see this play out in the public markets with that data set I shared with you guys a few weeks ago. Over 2/3 of companies now that have gone public since 2020 are worth less than the capital that they have raised as in the venture market. So if they were still private, they would be worth less than their preference stack. And that's where these companies start to unravel because now the investors have to totally recap the company. The founders don't want to have all of their common wiped out. Now they own nothing. And there ends up being a very ugly scenario that happens with the board at that point on how do we wind this thing down? How do we recap it? What's going to happen? And that's usually where everyone starts to run for the hills. The founders, one or more of the founders leave and so on.
Friedberg, I have a question for you. So you mentioned this earlier, which I think was a really important point, but we didn't really touch it. Do you think there's going to be a reckoning inside of venture firms about recalibrating general partners?
100%. I mean, look.
And why? Sorry, just explain why.
Yeah,
why?
So I think what's happened is over the last 15 years, to become a successful venture investor, you've gotten into the hot deals. The deals where, and hot deals, the valuations are typically climbing up. And, when the valuations climb up, that's an indicator that the company is doing well and you should invest. That's been the model for operating in the last 15 years. But the truth is that maybe just because the valuations have gone up and more money has gone in, doesn't necessarily mean that that's a great business, or as Chamath points out, that you ultimately get a positive net return on that investment down the road. And that window's now closed. So the investors that have been trained, this is such a generalization, and I hate saying it because we have so many good, smart friends that work in venture. But generally speaking, there are a lot of folks who have come up who have been trained on this momentum investing model. And it's like day trading. The stocks are going up. Let's all put money into the stock going up. Instead of having a more fundamental approach to, is there real cash generation potential and scalability and platformability of this company? And as a result, you're going to have to see, I think, the junior partners that have come up and done well in this market.
Can I build on your point?
Well, they've done well on paper, but they haven't done well on distribution. So maybe that, Chamath, becomes the way you decide who's a good venture capitalist. Which of these companies actually returned capital at a peak market?
Well, I think Friedberg is really onto something. And he mentioned this before, so I got curious about this. And I went into PitchBook, and my team and I looked at all of the people, the humans in our business, that have generated more than $1 billion in distributions on a given deal. And there's 20 that have done that in our industry. Like, there's people that have made hundreds of millions of dollars once or twice, but there's 20 people that have made more than $1 billion more than once, okay? And if you look, not a single one came up through the ranks as a pure engineer or product manager.
Right.
Everybody, 201, is extremely commercial in their background and their operating experience. Very few percentages of them were actually founders. A huge percentage of them were trained in banks and other places, so non-traditional, quote-unquote, roles for what this current crop of GPs look like, because we went through a phase where if you were a VP of product or a VP of design or a VP of engineering at a well-known startup, that was the most obvious onboarding into a venture firm. But if you just look back at the data, that cohort of people has actually never made money, again, according to PitchBook.
That's fascinating.
And that's a really fascinating counterintuitive takeaway, which is that, and by the way, what's so interesting about that is Pat Grady, I think, had a tweet. And it just sums it up so cleanly because he just hired somebody from Co2. And the tweet was something to the effect of, this guy is the most commercial guy we've ever seen, something like that. And I thought that was so interesting because that is exactly what our heuristical analysis of this data was as well. Commercial people in venture are the ones that make the money.
So you look at a Fred Wilson, Michael Moritz,
Danny
Bill
Reimer,
Gurley.
Bill Gurley, they were investment analysts
I can
in
share you the
public
list, yeah.
markets before they became venture investors. Or Mike Moritz, who was an
journalist, yeah. Which is, a journalist is just an analyst. It's another, if you're a good journalist, it's another word for analyst, yeah.
It was really, really interesting looking at that list. So there are people in there like Jim Getz, Alfred Lin, Danny Reimer, Jan Hammer, Fenton. So if you look at all of these folks that are just tier one people, and we know all of them, the one common thread amongst all those folks is that unbelievably commercial. And so, Jason, in a moment like this, where you have to really hold the entrepreneur's feet to the fire or be their partner to make extremely hard decisions, you have to have the ability to be respected by them in those moments where you can force a very difficult decision. And then separately, if you have to basically force liquidity so that you prioritize your limited partners, how do you do that while still managing the relationship with the entrepreneur? How do you know that you just need to cut your losses and get out? These are very difficult trade-offs that I think folks haven't been trained in doing, to David's point. So it'll be really interesting few years to see how these organizations
I think this
react.
goes to Sacks's point about, hey, the ecosystem, if it's hard, if it's cantankerous, if there's sand in the oyster, it could make the pearl. If you have a congenial relationship with, your product manager VC and everybody's champagne and caviar and high-fiving, maybe that's not as good as having a Bill Gurley, a Michael Moritz, and having a foil maybe who is putting pressure on the management team. Hey, we need to hit these numbers. Friedberg and then Sacks.
Yeah. Look, I think one counter argument here may be that there is this friggin' tidal wave of AI companies, and there is this incredible amount of lubricant in the dry powder that's sitting on the side of the of the market right now that all these venture funds raised in the last 2 years that is going to lubricate all these AI companies into every vertical and every market. So every company's wrapped up in an AI cloak, like a magic invisibility cloak. Every AI company's got an AI hat and a badge and a tattoo now, or every company's being rewritten as an AI company. And the money wants to find its way into AI, and it wants to rewrite every industry with AI. So I think similar to what we saw with mobile and the social web, going back 10 or 15 years, we're seeing kind of this AI wrapper and this AI technology enabler rewrite the possibility of every vertical. And the VCs have more capital than they had 15 years ago or 10 years ago, or even 7 years ago. So there is this counter narrative, which may be that the game goes on, the band continues to march on. The current crop dies out, but there's immediately a new crop waiting right behind it. Or what happens is the herd dies and everyone runs to the back of the herd and gets recapitalized. Because I can tell you, every startup I know that's not going well, everyone's talking about leaving to go do an AI company, and the venture firms are ready to write money. Yeah.
I think you're right about that. I think the question is, the actual person making the check, will they be more or less likely? And at least what history would tell you is that we've hired an entire generation of people that, and this is clear, do not map to the people in our industry that have actually generated returns. So you're right. They may take this money and misallocate it into these companies that are just, rebranding themselves. But that just goes and further proves that there is a type of person that hasn't been recruited into these venture firms yet that was the first generation that made all the money.
I think it's always been the case that there is some difference between the background of the VCs and the backgrounds of the founders. I mean, you guys mentioned Gurley and Moritz. Like we said, Moritz was a journalist who had written a book about Apple. He wasn't technical per se. And Gurley was a investment analyst on Wall Street before he then made the transition into VC. And as we both know, they're like legendary VCs. I think what you want to see in a VC, I think the background matters a little bit less than, like how curious are they? How good are they about learning a new area? How good are they at being like a heat-seeking missile? I mean, basically just like zeroing in on like what is the hot space and specifically what is the best company within that space, and somehow figuring that out. Being able to assess a founder, that's like a very subjective thing. So I think there's lots of qualifications that you want to see in a VC. Now, at the same time, I do think that if AI is the next wave and the next sort of platform opportunity, as we all think it is, I do think that places more of an emphasis on technical skills. And I was literally just having this conversation at Craft that, maybe the next hire we should make at Craft should be someone who's really deep technically, so they can, help go deeper on technical due diligence of AI companies.
They've never made money.
What's that?
They've never made money in the history of our business.
Who?
Those people. That archetype of hire has never done it on behalf of LPs or GPs.
In biotech and life sciences, they have. Usually the best investors usually PhDs.
He's saying a technical hire who worked in the trenches at a company is not as fit.
No, has not in the past.
Has not in the past gotten DPI, whereas somebody who is
more commercial,
able to analyze a business, commercial,
no, the ideal person
is going to be able to get returns.
Right. So look, I think the ideal person would be someone who's just fundamentally a great investor, but also has some technical background and some technical chops. We also have a team approach at Craft. So if you have someone who's very technical, they can just diligence the technical aspects of the deal. Somebody else can be responsible for making an assessment of the founders.
How we've solved this is we have a group of third-party individuals that we work with that we keep on retainer, that we compensate. And whenever we need to do deep technical diligence, we partner with them to do that work with us. And what it allows us to do is get the best of their technical thinking without also putting them in a position of trying to adjudicate whether this company is good or not. What I'm trying to understand is, what is this technical edge and can I understand the boundaries of that? But I still keep the investment decision to myself and my partners, because otherwise the difficulty is, in my experience, deeply, deeply technical people are extremely good at diligence, but generally are poor at making investment decisions because there's a part of their brain that flips on, which is like, I could do it better, or I could do it this way, or I could do it that way. And I think like that anchoring bias can be very dangerous. And you almost want to be a little dumbed down from that depth of knowledge, because you either find everything that is like not worth doing, and then you can miss a market, or you miss the thing that is good enough because you're like, oh, well, I would have done X, Y, and Z in a different way. So we kind of like use them, but we keep them at arm's length so that they never feel the pressure of having to actually decide on our behalf how the money should be spent.
Yeah, I mean, that's interesting.
Yeah, the number one thing we're doing at this early stage is training our founders, I know this sounds crazy, on accounting best practices and pricing best practices. And we literally have founders who have never made a plan. I'm talking about at the seed stage, who don't know accounting. And so we are running 4 seed stage startups, and I'm kicking myself that we didn't do it 2 years ago or 3 years ago, but better late than never, on how to just maintain their books and understand operations and the operational lack of discipline in the market. I'm seeing Series A and Series B companies that literally don't understand their own accounting. And so when we start talking to their accountants, there is a huge gap between what the accountants think of this business and what the founders think of these businesses. And founders think they have more revenue than they have or less revenue. They really don't even know how to calculate their runway in an honest way. And so there is, back to your point, Chamath, about on the venture side of the business, a lot of product focus, a lot of operational focus. There's not enough focus on just the bottom line.
The reason that happened is what Friedberg said before, which is like somebody would build something, there was a little bit of momentum, and you'd have to go and present these bona fides to these entrepreneurs to get into the deal. And so what venture firms thought was the right bona fide to present is, oh, I built XYZ product at this other company.
Right.
And they thought that that edge could get you into a deal. Maybe, but it could turn out that that was the wrong company to be in the first place. And so you just missed an entire generation of value creation because it happened sort of off-piste.
Off the trail. Yeah. You really do need to understand fundamentally, because we're talking about public markets here, the Facebook analogy, what is the ultimate earnings? What is the ultimate
buyer?
cash that is going to get thrown off this business? And that's what the whole industry needs to, I think, pivot to, and just that needs to be the operating principle.
Do you guys know how much money Facebook, Amazon, Google, and Microsoft raised combined total before they went public?
It's very small. I mean, Google is minuscule.
Less than $250 million.
Unbelievable. Yeah.
All
the inefficiency
companies
is extraordinary. And then on top of this inefficiency, I don't know if you're seeing this.
They were all profitable when they went public.
On top of all this inefficiency is a dependence on venture debt. I don't know if you're seeing this, Sacks, but the amount of focus on adding debt to unprofitable companies over the last 5 years has been just extraordinary. I don't understand what...
I've never understood the venture debt model or really how it works. I feel like it's a category that doesn't make any sense.
Say more.
I mean,
explain it to people what's happening.
I don't really understand how it makes sense for lenders or for founders, to be honest. I think the whole industry doesn't make any sense. For founders, I don't like it because the money has to be paid back, right? It's debt. So founders take in this venture debt thinking like it's an equity round, but without dilution or with some warrants. And they don't realize, well, wait a second, we got to pay this back in a year or a year and a half out of the next round they do. But that creates an overhang on the next round because the new VCs coming in, they want their money to go into the company, not paying off a bank. So it actually makes the next round less attractive. The other thing about it is that the lender is not getting an equity reward, so they don't want to take equity risk. They may be getting a nice, coupon. They might be getting 9% or something like that, which sounds high for debt, but they're not taking true equity risk in the company. So the last thing they want to do is be your last 6 months of runway, right? They want to be your first 6 months of runway and then get paid off on the back end. And I think a lot of founders think, oh, well, I'll take this money and it'll extend my runway from 18 months to 2 years. But what will happen in that last 6 months is all of a sudden the bank will come to you and say, no. Like you have this or that material adverse condition. It's called a MAC out. And there's all these like terms that founders don't understand because it's highly legalistic. Covenants. And so all of a sudden, the founders find themselves with a lot less flexibility in that last 6 months to a year. Either a covenant gets triggered that makes them pay back the money immediately, or their business flexibility goes way down because they're consulting with their bank about everything.
All of this is coming home to roost right now. Yeah.
I think it's a terrible deal for founders. And I think that even for the lenders, I mean, I guess I assume that these banks know their business better than I do, but I think that the reason I don't trust it as a category from a lender point of view or from like an investor point of view is that all the data about defaults over the last 5 to 10 years happened in this free-flowing zero interest rate environment. And so the startup mortality rates were artificially low because it was so easy to raise. So yeah, venture debt makes sense in an environment in which founders are generally able to raise the next round and then pay back the venture debt. But let's say that tweet storm you mentioned, Jason, can you bring that back on the screen? I actually think this tweet storm is basically correct. I've referred to on this show before that I think one of the things that built up during this bubble is latent startup mortality. So many startups that should have died from not being able to raise next round lived because they were able to raise money. And what this tweet storm is predicting is that in the second half of 2023 and then 24, you're going to have a huge crunch where all these companies have to go out and raise. They've been waiting. So they're all going to get to the point where their cash is so low, they have to go out and raise. And now all of a sudden they're going to be confronted with the new market conditions.
I wonder how many of them have venture debt as an overhang. And
those ones, yeah. And they're going to find they have less runway than they thought because, again, those banks, they are going to try and collect the debt before the startup runs out of money, not, when it runs out of money.
Catch two falling knives. You basically.
Yeah, exactly. So look, I just wonder, what I don't trust is whether the return models on venture debt that were created over the last 5 to 10 years will be a good predictor of what the returns will be in the next 5, 10 years when a lot of the mortality that should have happened in the past now happens in the future.
Well, I mean, and Sacks, correct me if I'm wrong here, but I'm also starting to see really gnarly term sheets, people foreclosing on businesses, people offering, like literally had a term sheet come in, like we're going to forgive the last note and take this business over for $1, and everybody gets wiped out. The amount of bad feelings that you have to go through, even if there is a core business, to Friedberg's point earlier, hey, they raised $100 million, but there's a $50 million business in here that people would love to invest in. Who wants to go through the hand-wringing, the negotiation, the toxicity of a recap? It's an extremely hard process to go through. Are you going through any recaps right now, Sacks? And what is the approach of the firm in terms of dealing with these kind of situations? Do you even want to start that discussion up, or is it too painful?
Well,
for a new company, not one you're already in.
We're not at I don't think for most of our companies, we're at the recap or restructuring stage. I mean, I'm talking about the ones that aren't going well. People still have a fair amount of cash in the bank. And we've been beating the drums for literally a year. But what about
new opportunities? A new opportunity comes to you. It's one of these overhang companies that wants to restructure. Would you even engage that, or is it just too hard?
I looked at 7 at the end of last year, and I tried to reprice 3 of them. And every single one was able to get a convert done away from us.
Yeah. So,
we tried to find a market clearing price for this equity, but nobody wants it, to David's point, because there's too much money on the sideline and people are willing to give them a lifeline that doesn't force them to come to hard terms with what the reality of the moment is.
Yeah, I agree with that. We're not quite there yet. And I think the reason why that tweet you posted got some traction is it's saying, listen, the crunch is going to happen second half of 2023 and 2024. That's where you're going to see the down rounds. That's where you're going to see the restructuring, the recaps, and all the rest of it. And look, I'm sure like every VC firm is going to be a player in that. But yeah, it's going to be a lot of miserable work
this is when you're going to see
founders.
This is when you're going to see people's true colors. When you have to recap a company, and this is when you can really start to see
how crappy it was in 2003 to be here. Remember 2003?
Painful.
Oh my God.
Oh my God. I found some. Yeah, there was.
You're lucky to raise $500K on a $3 million.
Oh my God! Yeah. Like 2004. Like what a brutal year.
Yeah, there's going to be a lot of that. I think the next 18 months or let's say the next 2 years, is going to be pretty rough for a lot of companies. And it's just that they didn't cut enough. I mean, we've been beating on the drums for a year for companies to lengthen their runway. And some did to some extent, but many didn't do enough. And they're going to get caught in this crunch. Can we just go to that chart that Brad put out? I think that what a lot of founders don't quite understand still is that things are just never going back to 2021. I think a lot of founders listening to the top of the show where we're talking about inflation is under control, they see the market rally, Facebook's up 25%. They may be thinking, okay, we just have to weather the storm for 6 months or a year, and then everything's back to normal. And I think what's important to understand is that the market did bottom out about a month ago and is up pretty nicely. If you see here, this is the SaaS index. It's the median enterprise value divided by next 12 months revenue. And it was really beaten down about at the end of the year. At the end of last year, coming into this year, it was like 4 to 5x multiples of next 12 months revenue for SaaS companies. That's all the way up to 6.1 now. So you're talking about 20 to 50% rally for a lot of companies, which is huge. We're still below the long-term median, which is just under 8. Okay. But what people need to understand is that even if we revert all the way to the mean of 8, which I think at some point we will, that's still well below the bubble of 21 where they got to 16. So even if things continue to inflate, valuations will still never quite be where they were in 2021. And
if you think it's getting back to 12 or 16, it's not happening.
30.
Fetch is not happening.
For high growth companies, in 2021, you were in the public markets, you were seeing multiples of 30 to 35 times. Now those companies are maybe at 8 to 10 or 12.
I think the reliable way that we can look at this for the future is that we're never going to see these kinds of multiples again unless rates are zero and all kinds of tourist capital need to find a home to escape 0% returns in every other asset class. But if even the safest asset class now will give you 3.5%, 4%, this is probably the new normal for quite a long time. And we're going to be back in that early 2000s kind of mindset, which takes a lot of hard work to build value around.
We talked about the sort of whipsaw economy, and there's a lot of mixed inflation data. I think founders need to understand that there's a bifurcation. What's happening in the tech ecosystem is not necessarily what's happening in the overall economy. The tech ecosystem is clearly going through a reset and a recession. Job cuts are now the rule. Valuations are much lower. Whereas in the overall economy, we saw a jobs report today of over 500,000 new jobs. So the fact of the matter is that even if the overall economy avoids a recession, that doesn't mean that things are just going to bounce back.
Tech's in a depression/recession. Best
Really
case is recession for tech.
Tech is a boom bust cycle, and we had a phenomenal 10 years of boom. Now we're in a bust. And so I would just tell founders, look, it's good if we have a soft landing in the economy. I wouldn't assume that that's going to happen. I still think there's a really good chance of recession later this year, but it almost doesn't matter for you. What matters is your business and the capital availability for startups, which is fundamentally different and will remain different than it was in 2021.